A tax on wealth is taxing illiquid assets and requiring cash transfers from those illiquid assets. Most of the wealth of billionaires is in what? Is in shares, okay? Shares in the stock market. They're not selling them, but more importantly, if they had to sell portions of that wealth in order to pay the tax, what would happen to those shares? Exactly. Those shares would fall in the stock market, because if the biggest owner of a stock is reducing its stake in the company, while and you see that there is an increasing pressure to make that person sell more of his stock, the value of the company is going to fall in the market. Absolutely it will. It has always been that case. So the idea of calculating wealth without it being without there being any transaction that proves that that wealth is real is simply paper calculation. It's a paper calculation of the transaction value of things that have not been sold, of things that have not been transferred. And so if you put a cash tax on paper valued wealth, it is extremely likely that you will see three things. First, capital flights. It's going to be impossible for people that are rich in assets but don't have a lot of cash to pay that tax, and therefore they will look for any option to move that wealth elsewhere. The second thing that you're going to find is that the tax revenues that they estimate that they're going to collect out of this tax are much lower than what they expected. So one, you're not going to reduce the deficit. Two, you're not going to reach the level of revenues that these people need for their massive entitlement programs. Third, very important factor. So we said first, capital flights. Second, lower revenues than estimated. Third, an absolute destruction in the incentive to create more jobs, to invest more, and to attract capital into the country. It is basically a warning sign saying, not in this country. Don't invest in this country. There is a reason why most of the Eurozone countries, all of them except two, have decided to eliminate the wealth tax. And the reason why they've done it is precisely because the negative impact on investment, on job creation, and on improvement of the economy in general, and on tax revenues, the negative impact of all of those was much larger than the alleged benefits of a few million euros or dollars collected from revenues. There is absolutely no way in which a wealth tax would pay for the trillions of dollars of expenditure in entitlements and in different programs that we're hearing. Absolutely no way. But more importantly, there is a reason why the United States or countries that are talking about this have today a strong financial position. Is precisely because there is an incentive to keep the latent wealth without being transferred to cash, that people prefer to maintain their wealth in the country, in shares, in illiquid assets, which are investing in the economy. The opposite only destroys the wealth creation and the improvement in jobs and in investment. And obviously, once you look at it, the first thing that anybody that has any chance of success is going to do is to try to avoid at all costs reaching that level of wealth. So it not only works as a deterrent on future investments, it also works as a deterrent on actual current wealth. It's an atrocious idea that has never worked in the French Revolution, that has never worked in so many other cases in which it was implemented. And what happened in the French Revolution was pretty evident. After confiscating wealth from the rich, what the country ended up having was one, no more wealth, two, a massive outflow of capital, three, no real investment in the economy. As such, this concept of a wealth tax needs to be extremely well analyzed before it's even implemented, because the effect can actually be, and will very likely be, exactly the opposite of what it intends to achieve. Thank you very much.